Hello and welcome to another episode of Voyage 2019, the flagship event from Aditya Birla Sunlife Mutual Fund. This year, the annual event saw distributors from across countries discussing the best way to meet customers' investment goals as well as highlighting the course of India's $5 trillion economy. On this episode, we bring you the highlights of some interesting conversations revolving around key events to watch out for from markets perspective in 2019. But first, let's hear from Mahesh Patil, CIO Equity at Aditya Birla Sun Life AMC, who talks about the equity outlook of shaping India's $5 trillion growth agenda.
Welcome to Voyage 2019 to share the investment perspective on equity. So every time when we talk about the markets, we really look at something about one-year view or two-year view. We thought it was important this time because a lot of uncertainty around in the markets, globally as well as domestically. It's important to take a longer-term perspective, and that's why the theme is India, whether we are headed for a $5 trillion economy. So if you look at in the last decade or so, it's been a kind of a Goldilocks scenario where we had stable growth, low inflation, low interest rate, and post the global financial crisis, easy liquidity which was available. And markets did fairly well. I mean, US was the best performing market. Indian markets also didn't do all that bad. But last year was a year where we saw a huge amount of volatility, right? All assets gave negative returns, including equity, debt, gold, commodities. US dollar was the only positive asset class. But as we step into this calendar, we have seen a smart recovery in the markets globally, as well as in India. The key question is there any change in narrative compared to last year vis-a-vis this year? So if you look at in calendar year CY 17, we had a synchronous global recovery. Everything was recovering across the world. In CY 18, we saw some kind of a divergence over there. While US continued to pose a stronger growth, we saw slowdown in Europe, Japan, even in China. And in CY 19, we are seeing a synchronous global slowdown which is happening. So that is a big change. India is actually seeing a slight acceleration in terms of growth. So that's a big change. So the macro environment looks fairly good at this point in time compared to last year. So the key question is, if you take a longer term view, is the foundation in place for India to reach to a $5 trillion economy, and how soon that will happen? That's the key question we would like to address. I think we have seen big reforms. I mean, after 1993, the Narasimha Rao government, I think we have seen first time such large, big ticket reforms, which we think have laid down the foundation for us to really charter that path. Consumption has been the mainstay of our growth, right? So in the last decade, consumption grew at around 13% CAGR. It's likely to continue to that growth momentum and grow at around 12% CAGR. But the faster growth would be in areas like consumer durables, retailing, footwear, apparel, healthcare. So that's an area where we should see a stronger growth. Though I would say that currently we have seen some slowdown in some of these sectors because of the tight liquidity conditions we have seen in the NBFC space. But we think it is temporary. And I think India should see a stronger growth in the consumer durable space. Again, a big change for India has been transformation what we are seeing on the digital side. Similar thing we're going to see in mobile broadband. So big leapfrog. Thanks to Reliance Jio, we have seen crash in the data prices and availability of broadband. So we are expecting the total broadband consumer base will quadruple over the next 5 years. From 2016, from 200 million, is likely to go up to 800 million. So that again will change the whole profile in the way India looks at. For GDP growth to sustain above 7%, we require big push in infrastructure side. This government has done a lot of focus on infrastructure. And infrastructure, as you know, is more productive investment. The multiplier effect is much better. And if that happens, then that should enable us to really sustain growth at around 7%. To some extent, this slowdown, what we have seen in the economy is also because of the tight liquidity. Banks were not lending because, especially the corporate sector. I think with the bank's balance sheet and profitability improving, we should see the lending from the banks starting to improve. In fact, if you look at last quarter, corporate lending, which was kind of flattish or negative, has seen an improvement. Even from a market perspective, while people talk about election as a big event, I mean, our experience in the last 4 elections, where we have seen various governments come and go, while there has been short-term volatility, 6 months after the election results, markets have always delivered positive returns. So that's something which one need to take cognizance of. I think the change what we are seeing in India in terms of money, financial savings coming into mutual fund industry, I think that trend will continue. And there are various reasons for that. I mean, real interest rates, new investors coming into the investor base. And also, we've seen because of education program, people are now comfortable with volatility. We have seen recently, last year, when there was huge volatility in the markets, the SIP flow continued to remain fairly steady. So just to summarize over there, I think from an Indian economy standpoint, globally, we are seeing favorable policy environment. Domestic growth, while it is currently slow, we think the framework is in place for growth to sustain, if not accelerate beyond 8%. I think around 7.5% growth is quite possible. Again, consumption will be the key driver. Investments are also likely to pick up. And if we look at the overall macro picture, if we indeed reach a $5 trillion economy by 2025, which is not a tall order actually. If you look at that's kind of a nominal growth of around 11.5% or so, and market cap to GDP at various levels, we can calculate what kind of a returns the market could give over that time frame. Mind you, there will be a lot of volatility in between this process. But I think there is no doubt in our mind that India has the framework in place for it to take to a $5 trillion economy. So that's it. I think we could look forward. I think the near term always looks uncertain and this thing, but as we take a longer term view, I think the picture gets much more clear. I think that's the key message we would like to drive home at this point in time. Thank you.
I'm going to start where Mahesh left. He kind of hinted at global uncertainty. My focus is going to be more in terms of near-termness in the way our macro is evolving. The prospects for the Indian economy is pretty bright over the next couple of years. At this point in time, of course, India as well as rest of the world is experiencing a cyclical slowdown. Pretty much all indicators that we track are actually hinting at a mild slowdown in our economy. So the big picture, of course, is that the general economy has kind of slowed pretty significantly over the last 5-6 months. But within economy, about 60-61% of our economy is consumption. So we are fairly consumer-oriented economy, and that part of our economy is actually slowed quite substantially. Now, there are a couple of reasons. It is not fairly certain though, because as to why our consumption, which has gone quite well for the last couple of years, why is it slowing? So these are our speculations. These are the things that we think maybe that pay commission, which was rolled out in the middle of FY17, that's beginning to fade. The other reason, of course, that is not yet talked about is the tight monetary policy that we experienced in the first half of 2018. Interest rates were lifted. RBI talked up the rates. This also led to higher EMIs, and because Indian consumer is getting a bit more levered than it used to be, its impact, the monetary policy impact, is going to be felt a lot more on consumption than it used to a couple of years ago. So these are the two reasons: the monetary policy tightness and the pay commissions fading could be reason why Indian consumption is actually decelerating as we speak. But from a broad, very big picture standpoint, it is likely that the impact of stimulus that low oil prices gave to our economy may have actually begun to fade. So there is no precise way to know again is that how much of this oil stimulus converted into India's growth. But we think, and in our assessment and analytics, oil prices now have actually begun to kind of hurt India instead of actually supporting. So that could be one big macro reason why India is experiencing a bit of a macroeconomic slowdown. So that's a big picture in terms of our growth. Now, what are policymakers doing right now? And is the policy in India at margin is supportive for growth, or it's hurting? One, of course, a big policy is the fiscal play, and unlike what is being told to all of us by the government of the day, that fiscal consolidation has been underway, quite the opposite for last good 4.5 years. There's been a fair bit of a fiscal, I wouldn't say profligacy, but fiscal has actually expanded. It's not necessarily contracted. So basically, the big news is while the general growth is experiencing a bit of a cyclical downturn. Consumption is at the forefront of it, which is is under relatively deeper downturn. We're having policy impetus, and most probably would mean that the downturn is not going to be deep in a substantial manner. There are early signs, and I think we talked about in the last voyage also, that early signs that the capex in India is actually beginning to gain traction. One such indicators, of course, is that our capacities, we built huge capacities during 2003 to 12, and since then we've been stuck with very, very high capacities and low utilizations. Actually, that's beginning to gain traction, and many sectors, across that you see, since the capacities have actually risen quite substantially, it is very likely that newer capacities would get added over the next couple of years. So the big picture, of course, is that my sense is that after a fairly long hiatus in terms of capex expansion, we're beginning to see a reasonable traction in the capex. It's going to be a very slow process. Unlike in the past, this time around, our banks are, as Mahesh mentioned, while the NPAs are actually coming off, the stress in the banking is still fairly high, and I think our monetary policies have tightened significantly more than what they did in the past, and which is precisely why the capex recovery in India is going to be a lot slower than what otherwise you would have imagined in a country like ours. So that's about growth. Net in near term, consumer slowing down and capex beginning to recover. So which essentially means that unless there is the downturn in the world is not very deep, it's very likely that India would actually do fairly well. Now let's quickly move to the next big macro variable, which is inflation. It's, of course, we've been talking about it for the last few years. India's inflation has actually come off quite substantially. It is very important to understand the context of India's inflation. For good 40 years, from mid-70s until 2013-14, we've actually averaged at about 8% in terms of inflation, and since then, it's just 4.5%. Now, this is very, very important for a lot of you and us in terms of pricing assets, because understand that in the end, all assets are going to be priced to inflation, be it fixed income, equity, or real estate. And if inflation has come off by about 3 to 4% in India, accordingly, most assets too would have to be repriced, and the nominal growth of economy, nominal growth of earnings, and everything would have to get repriced. So the drivers of inflation, of course, at margin are going to change. Most probably you will have a non-food inflation coming off and food beginning to creep up. India's rise actually is happening in the backdrop of a sharply slowing China for reasons that we all know. One, of course, is the population growth, and second, of course, is that China has overbuilt itself, and it's very unlikely by building roads to nowhere and bridges to nowhere, you would begin to see, you would most probably see China at margin slowing down. Backdrop, India would most probably not only become a $5 trillion economy, but for all the reforms which have been undertaken, it's very likely that if we will not only muddle through, but maybe accelerate from here and get to about $8-9 trillion economy in 2030. Thank you.
When we return, more insights from experts who will engage in a power-packed panel discussion about identifying the propellers of a $5 trillion economy. Welcome back to Voyage 2019, presented by Aditya Birla Sunlife Mutual Fund and powered by ET Now. Let's take a dive into what industry leaders believe it will take for the Indian economy to reach the $5 trillion mark, along with some insights on how to build a sustainable business model in mutual funds in 2019.
Let me just kickstart by asking, this side of the stage, really what you feel are going to be the drivers for the economy, for growth going forward, and also at the same time, what you think will be the constraints?
The drivers for economy are pretty well known. Is the low per capita income, is the fast emerging middle class, so on and so forth. So there are large number of basic on the ground factors which will drive 6 to 7% GDP growth on a real term, and 10 to 12 or 10 to 15% GDP growth on nominal terms. So as I see it, the factors that can take the Indian economy to a $5 trillion number are pretty well laid out. We just need to execute well on the ground so that we can achieve this desired result.
What do you think? And we've got the fixed income side here, but from a more macro standpoint, really, what are some of the signals you're watching out for? What do you feel the key enablers are at this point?
So, I call it the 4 Ds which gives confidence about India's growth story. First D I would call it will be debt. We are quite under-leveraged economy. In a world where everybody is over-indebted, I think it's a very big positive. Second, I would say demography. We are a pretty young economy. Globally, by 2020 will be, I think, our median age will be around 29 compared to closer to 35, 36 about China. Third, I would say is democracy. We don't, many times we fail to understand the importance of that, but it creates a lot of institutional stability, a lot of stability in terms of decision making, in terms of checks and balances. That's a very big positive for longer term growth for the economy, for investments. And I would say the fourth key D would be the distance from frontier. We are still quite far off from the best in class in terms of whether it's per capita income, in terms of productivity, also in terms of urbanization. So there's a lot of scope for catch-up for India, which is still there. In most, I would say, most forecasts should be that India will be going towards 5 trillion, just a number. I think there's still a very long way to go for India going ahead. In terms of constraint, if you put it, I would say governance deficit can be one constraint. In terms of ease of doing business, we are still pretty low. In terms of infrastructure, I think is still pretty low. Our cost of moving our logistics is still quite high. So in a very globally competitive economy, that becomes the key constraint.
Pranay, again, when we talk about long term, and everyone knows, sure, when you're investing, think about the long term story, the bigger picture. When you're thinking about India's growth and the amount will pick up from here, what is the timeline you're looking at?
We are on the path. I think we are accelerating on the path, and I don't see us taking much longer. So in terms of poverty elevation also, you can see we have made huge progress in the last couple of decades. To that extent, I think we are already halfway on the path, and another 5-10 years, we would be coming halfway to China or maybe more to China, and that would be a great progress for us, right?
Okay, so I want to probe you a little bit more on the equity side as well. Ajay, let me get you to sort of share your thoughts on really what the kind of growth possibility you see on equity returns versus GDP.
So what growth we saw in last 10 years from equity markets. And as the world is slowing down and India is also stepped back on the growth side, you will tend to think it is going to be lower than what we had in last 10 years. But if we look at what has been put in place in terms of building blocks, foundation, the biggest one in last 6-7 years, I feel, according to me, has been GST. So, and it will act like a catalyst. And with the smartphone penetration and telecom rates being so low, so next 10 years are going to be much brighter than what we saw last 10 years.
When we're looking at an India that's poised to hit 5 trillion, and we're looking at more inclusive growth, we're looking at several drivers of the economy that all of you have highlighted. How soon do you expect to see broader participation? And this relates even to the equity market.
This year we see broad markets coming back. 2018 was clearly a very difficult year. And if you saw the performance of some of the indices and some of the stocks, it was already a handful of stocks which are doing well, whereas the broad market was under recessionary pressure. Largely because in 2018 we saw a massive volatility in macros. A volatile macro environment is never very good for equities, and that's what got reflected. Also, please remember, we were entering 2018 on back of a robust, massive 2017, which had done, where equity markets had done very well. So some bit of correction was overdue, and probably that came in. Having said that, we are entering 2019 on a much stronger, much better macro environment. So our sense is that this better macro environment, plus hopefully with the political leadership also in place for the next 5 years, we should see a much broader participation in terms of equity, not only from domestic investors who have been very bullish on equities and the flows have been strong, but also foreign participation. We already seen some bit of that happen in the first half, but in the last 2 months. But we should see much broad-based participation from foreigners as well as Indian investors into equities. So we think that equities, particularly small and mid-cap names or broader market, will do reasonably better, or probably significantly better. Let me put my hat out and say that significantly better than the large-cap market over the 12-18 months period, assuming some of the key macro headwinds that we faced remain stable.
Awesome. So on that positive note, really, I think the takeaway is where else but here. That seems to be the clear message coming in, and no major clouds in sight, particularly if you're looking at the longer term story. The path to 5 trillion is clearly ahead of us. So on that note, gentlemen, thank you so much for joining us and sharing your views with us here today. Thank you.
Thank you.
Thank you for joining us on Aditya Birla Sunlife Mutual Fund presents Voyage 2019, powered by ET Now. We'll be back next week with some more thought-provoking conversations with our distinguished speakers. Till then, keep watching ET Now.